Right, here you go. Hot stocks time. It's just Nerina Visser and myself in studio because unfortunately Bronwyn's voice has disappeared.
Left it in China, I think.
Yeah, you know, all this flying around on airplanes, that's probably the reason. Then you pick up those weird bugs.
Definitely.
In any event, Nerina, of course, is the exchange-traded fund and exchange-traded note specialist. We have her on often because, you know, there's ordinary stocks and then there's all this other stuff. And the other stuff is growing in popularity.
Absolutely.
A lot of investors looking to acquire these things, but we're not going to talk more generally about that. We're going to talk specifically about global and offshore investing, utilizing these products.
Yeah, which is also growing in popularity, global
Indeed.
and offshore investing.
For obvious reasons. People worried about politics, the currency, and international markets have been doing well. But before we get into that conversation, which is going to be sort of loose and unstructured, not like our usual 5 stocks, hot stocks, this, that, and the other, let's have a quick look at those portfolios. If only Bronwyn had been here, because she always gives me a hard time when the market does badly. And I don't know what it is. It's the days when the market does well, then she's not around here to get excited about
She's
the numbers.
obviously propping up the market somewhere out there on your behalf.
That's probably the reason. Anyway, let's have a look and see how the US and the international and the local portfolios did overnight.
With a strong
So the
rally.
JSE portfolio number above 450, one giant leap yesterday. We had most stocks in the green. That's nice. The biggest mover, in fact, was Mediclinic, which is not really doing all that well, but at least it was going up. Up is good, 2.6% increase. And then US portfolio also up above the $43,000 mark, which means that we're basically close to 20% higher since August last year, which is, you know, good and well. And that was tech stocks rallying. Facebook was at an all-time high, 158, which tells you that's why people are interested in these offshore things. Right, let's get a swipe, sting thing across the screen just so that mentally you know what's going on. It's this pink thing that appears now. Right, Nerina, so start me off with that argument again. Like, what kind of products are these? Why do people buy them? What does it relate to that whole thing about global and offshore?
Right, so let's maybe just start with the exchange-traded fund idea. As you said, on the stock exchange, you can buy individual shares or you can buy these funds that represent a basket of shares. And there's many different types of baskets, but the efficiency that it brings to the trading argument really says with one trade, I get exposure to a whole range of investments.
Even if you've got a small amount of money.
Exactly. And that's really why it's sort of seen as a way to democratize investments. It makes investments more readily available to the ordinary man in the street.
And they track an index, so it takes the thinking out of what to own, and that often brings costs down.
Exactly. Why it is so important that you understand what index is being tracked by a particular ETF, because the exposure that you're getting through that investment and the expected payoff profile that you get from the investment directly correlates with whatever the index is that it tracks.
Yeah. But the big global indices that normally people go for are those that represent the biggest sort of aggregated market. You can, of course, buy exchange-traded products that correspond to sectors, but that's not what we're going to talk about here.
Sure. So I think if we were to start with contrasting maybe the concept of global investments versus offshore investments.
Okay.
So I think offshore investments are a very hot topic right now for obvious reasons, as Paul said. But the way that I see offshore investments is that is anything except South Africa. And typically this is something that is done in a foreign market, in a foreign currency, and from a foreign bank and investment account. So the big difference there is foreign currency and the fact that your money is physically in the market outside of South Africa, and South Africa is not included in that investment.
Okay.
Contrast that to global investing, which not only includes South Africa as part of the globe, but also more importantly, that typically relates to rand denominated investments. So these are investments that you would do in South Africa in rands from your normal stockbroking account or your LISP investment platform, but it gives you the exposure to investment opportunities around the globe.
But typically they are products that are priced in rands and only redeemable in rands.
Exactly.
And when they kind of come to the price, they are taking into account some sort of dollar-rand adjustment.
Exactly.
So you might buy something which is offshore and tracks a foreign index and it does well, but it might do additionally well or not so well depending on what the rand.
Exactly. So there really is two sort of investment decisions to make here. The one is the underlying market. The US markets, as you mentioned, we certainly know they've been making all-time highs for a couple of months now, but then there's also the rand-dollar exchange rate, and exactly as you explained.
Just one more technicality. To get money offshore for real, you either have to go to your bank and send money out using your discretionary allowance, up to 1 million rand per person per year. If you want a larger sum than that, you have to go to the SARS office in your area and get exchange control approval, which is a bit admin intensive.
Yes.
Once you've done that, though, you can really send money offshore.
Indeed.
If you don't want to do that, or you can't because you're investing in a trust or a company, then you can buy these products, which do track these global indices, but they have the limitations we mentioned earlier.
So there's certainly pros and cons around each of these. A lot of people prefer physically having the money offshore, but it is more onerous and restrictions do apply. When it comes to these global investments listed on the JSE or available in South Africa in rand terms, there are no restrictions on the retail investor, which means you can invest an unlimited amount in these global investments.
Okay, we're doing a lot of preparatory work, but that's fine. People need to understand this. The other thing I want to just get your run through is there are different companies that provide these products.
Yes.
Just tell us who those are and which is the most important in terms of the market share that they have of these kinds of products. And we're talking specifically here then this offshore category.
Sure. So in South Africa, the exchange traded fund market originated with Satrix. To this day, they dominate in terms of the range of their products, but for a long time, they only offered domestic equity. So the underlying indices were all South African shares.
And Satrix used to be a joint venture between different parties, but it is now a wholly owned subsidiary of Sanlam.
Exactly. So
part of the Sanlam
very
family.
important. Now, the former partner of Sanlam in owning Satrix was actually Deutsche Bank. And Deutsche Bank is another of the major players in the ETF industry in South Africa under the brand name DBX Trackers. Now, recently there was an announcement that Signia has bought the management company, the Manco, so to speak, of the DBX Tracker exchange traded funds. And that deal was effective on the 1st of July, so this is quite new.
Now, why would Deutsche Bank sell that? I mean, Deutsche is a big player in these products globally.
Yes.
But we know Deutsche has had a few problems of its own in its home European market. They're still an operative investment bank here in South Africa. Why would they sell this particular unit?
So I think part of this relates to much that we've seen in the global finance space and the global banking space, where the capital adequacy requirements for banks operating in foreign jurisdictions really does not make it as profitable as it otherwise would have been. We know what Barclays has done. We've seen HSBC do the same sort of thing. So I think it is all part of this reason why Deutsche sold this particular business.
Signia is a Cape Town-based asset management firm, quite young, insurgent, growing its assets under management, best known for its colourful CEO Magda Wierzicka.
Indeed.
They look as though this is a supplementary business for them because they're also involved in actively managed funds, right?
Indeed.
But they are dedicated principally to sort of low costs and doing things differently.
Yeah. So I think Signia started out very much as an asset and administration company. So they've been the administrator behind many of the multi-managers, many of the unit trusts that are available, and they are now increasingly branching into asset management as well, not just administration. And because they're also big players or would like to be big players in the retirement fund and the umbrella fund space, Magda as well as her husband Simon are both actuaries. So this is their natural habitat, and I think they're certainly seeing the benefit of the low cost and transparency of index trackers, specifically for retirement funds.
Customers are going to want to go there.
Exactly.
What about core shares?
So core shares is the other one that offers international or global portfolios on the JSE. They certainly is one of the strong and upcoming growing companies in this space, and they were the first to list an S&P 500 ETF late last year in October, and they also listed a global property ETF. So those are both already available.
Is part of the Grindrod Bank, Grindrod Financial Services Group,
and
right?
they are also partly owned by Rand Merchant Insurance, RMI, so yes, they've got more than one shareholder also. I think important to understand the difference between who just owns the company and then who is the management company that's responsible to administer this exchange traded fund. Most importantly though, ETFs are all physically backed funds held in ring-fenced trusts, so the issuer of these ETFs doesn't have any bearing in terms of the credit worthiness of that that investment. They completely...
Provided the administrative system is sound. I mean, does the JSE make sure that nobody lists these things if they don't have a proper admin system at the back? Imagine how it would get messed up if they weren't following the index properly and didn't buy or sell the required number of shares.
Absolutely. So the requirement in terms of JSE listed ETFs is actually that they do full replication, meaning that they've got to own all the shares in the same proportion as it, and there's a trustee sitting behind each of these. Most of these ETFs are also registered as collective investment schemes or as unit trusts with the FSB, which brings that extra regulatory level into it, which makes them some of the most secure from a regulatory structure point of view investments that one can get.
Have I left anybody out? So if you go Satrix, you go DBX, iTrix, and then CoreShares, is there anyone significant? I mean, there are
the other significant player is APSA, and the reason why they are significant really is because they've got the 3 big commodity ETFs. So New Gold is something that many people would be familiar with, but there's also platinum, palladium and rhodium. And if you just look at assets under management, APSA appears to be the biggest because the bulk of the ETFs are really those commodity ETFs, and that represents almost half of the industry in South Africa as it stands at the moment.
That's astonishing. But we're not going to talk about that today.
Another day.
So now let's get our heads back here. We've got this global investment option, and broadly speaking, you can either go for a world MSCI index, or maybe you can pick a country like the US or the emerging markets. So why would people have those different strategies when they take their money out, or when they look to get exposure to these international asset classes?
So let's maybe start with a world one. I think what you're really looking at there is in a single trade to get exposure to as much of the global investment opportunity that you possibly can. But there's a bit of a snag in the term the world index, because actually the MSCI World Index only represents developed markets. So it doesn't include any of your emerging markets.
What? That's
and nowadays, you might be surprised to hear that emerging markets actually represent about 60% of the global growth rather than developed markets.
Global growth?
Yes, yes.
What about global market capitalization?
So global market capitalization, you are also looking at only about 60% in developed markets. But there's a very important but around this. A big part of it is China.
I was going to say, what about those
Chinese?
Chinese?
Because China is the second largest stock market in the world. But you can't easily get access to it as a foreign investor because of the restrictions that they've got.
The state ownership of a lot of those companies, which
That's
then gives them an inflated value.
But it means that there's a big disconnect at the moment to the makeup of global growth and the makeup of global stock markets.
Didn't MSCI, the people that do these index products, used to be part of Morgan Stanley? That's where the MS comes from.
Yes.
Didn't they recently make a decision to include China?
Exactly.
They gave it the thumbs up.
They did, but it's going to be done on a very gradual basis. So it will be, it's the so-called China A shares, which represent those that are listed on the Shanghai and Shenzhen stock exchanges. And this is a process that's going to take probably the best part of 5 to 10 years to gradually bring the full reflection of the Chinese stock market into global indices as we have them.
Okay, but to come back to first principles, and I must stop in a minute and take a break, but you would go global and buy these MSCI world indices because you don't really want to get involved with picking whether, you know, Trump's America is going to do better than May's Europe, or, you know, China's going to be fine or not fine. You just want to buy the whole thing.
Exactly.
But what you're saying is, unfortunately, it's not quite as simple as that, because there's some hitches here. You're going to get some sort of index variability as you go along anyway. So does that mean you prefer the S&P 500, which just is admittedly one company, but those are the world's biggest and most sort of liquid and clearly visible companies, right?
I differentiate between whether I'm investing for today, the present, or whether I'm investing for the future. Developed markets, US, S&P 500, the world, MSCI world being developed markets, is what the world looks like today. If you want to be investing for the future, you've got to be investing in the emerging markets, because that's the biggest growth area.
I hear you, but if you own South African stocks, you're already in and invested in an emerging market. Why would you take your offshore commitment or your global ideas and then go out and then come back in again, in a sense?
Because less than 7% of the emerging market index consists of South African stocks.
Of course, we're totally unimportant.
So there's 93% of other emerging markets out there that you want to get access to.
I hear you, but those other emerging markets are like us. They're messed up. They've got bad politicians. They've got weak currencies. They've got commodity-focused economies. We don't want to go there. We want to go to where the people have money and the institutions are sound and secure. Not
and
so?
everything is absolutely hunky-dory in the US and in the UK and in Europe. And you know what? It's the reward trade-off. That's what it's all about. Yes, there are more risks in emerging markets. That's why I say it's a longer-term investment. It is for the future. That's where the rewards are going to be coming from.
Okay, I think we're going to need to take a break. When we're going to come back, though, we're going to talk about the fact that Satrix is launching a whole lot of new ones. So that means that there's going to be an IPO of an ETF. That sounds like, 6 digits too many and an acronym soup that you're going to battle your way through. But we'll talk about that.
Sure.
And then we also talk about the issue of costs, because there's some issues here about, differentiation of costs. So, Nerina, you mentioned that the DBX trackers, soon to become Signia iTrixers, if that's the right word, are there and have been around a long time, and a lot of people have invested in them. Then there was Core Shares, which launched the S&P 500 thing that you tracked. Satrix, which was mostly domestically focused, has now plans to launch a whole slew of these things, which will track the same index. So just tell us why Sanlam stroke Satrix decided to do that now, and what the standout products are, and then also what does it mean to IPO a thing like this?
Absolutely. So I think first and foremost, this is not something that happens overnight. So this isn't a fad that Satrix now suddenly decided, oh, let's get on this bandwagon. In fact, they've been running index tracking unit trusts on these indices for an extended period of time, also under the Satrix brand.
But not exchange listed?
No, exactly. So that's what they're doing now, is to bring some of those onto the exchange and listing them there.
So who are they providing them to? Institutional investors and
retail
other pension
investors.
Fund managers?
Yeah, so they had an MSCI World feeder fund, and that's quite an important concept also. It means that what sits behind this, Sanlam doesn't have to go, Satrix doesn't have to go and buy each of the individual 1,700 stocks that make up the MSCI World Index. They buy the BlackRock iShares MSCI World ETF, which is already done and packaged and comes at significantly lower costs than one would normally have if you've got to manage that whole portfolio yourself.
And is this going to be the same thing? So they will list it on the exchange, make the market, but they will do the back end using a foreign partner like BlackRock or
these products are registered with the FSB as feeder fund CISs, so collective investment schemes. So they're very much regulated by the FSB as well.
Well, that's good news, because BlackRock and Vanguard and these kind of people have more assets under management than our GDP 10 times over. So I'm glad the FSB in Pretoria thinks that they're up for it.
Absolutely.
So what will the IPO then mean? Because almost from day one, if someone, they will just make a market, right? So it'll come on the first day and you can just get stuck in and keep going.
So it's an important question, because an IPO is something that might be very familiar to viewers in terms of a new company listing on the market. So IPO, it stands for Initial Public Offering, and typically with a new company listing, there would be a valuation that is done by an investment bank, a corporate finance team that really sort of says, you know what, this is the value of the company, and we expect it to list on the JSE at, let's call it 10 Rand a share. And then interested investors can say, I want to participate in this, and they apply to be allocated a certain portion of those initial shares that are made available. Often people look at such an IPO as an opportunity to get shares into a new company at a discount, because it often happens. So there's this buzz around an IPO, and it's like, oh, let me get in a discount, and on the first day of listing, I'm going to sell and make money. Doesn't always happen, but there certainly have been many examples of that happening.
Surely it's not going to happen here.
An IPO for an ETF is something totally different, because the ETF is valued exactly the same as the index value is. So the value of that index, and therefore the ETF on the day of listing, is what it is. It depends on what the value of the underlying shares are. So why bother going through an IPO in this sense? So really the biggest benefit for anyone participating in it is that there's no brokerage payable. You are issued those shares on the day of listing rather than having to go and buy them in the market.
A book build. You can
They are, although I think time is pretty much up. That IPO closes on Monday, and many of the stockbrokers have got their own cut-off dates in terms of this. But maybe if you move very quickly tomorrow morning, you can still get it in if you want to, but there's no need to rush into this. These ETFs will be listing on the JSE on the 25th of July, so the next Tuesday, and it really just means that as soon as they are listed, you can just buy them ordinarily as you would any other ETF.
Okay, but now let's say I'm pro-America. Notwithstanding the current incumbent of the White House, just for the record, and I want the S&P 500 tracking product. I can right now go and buy the DBX US which will become the iTrex US, and I can get stuck in and get started. Why would I want specifically to have the one that Satrix is bringing, which is going to track the S&P 500? What's the difference? And
so
critically, what about fees?
Fees. So fees is the one difference, but the other critical difference also is the underlying. So the DBX US tracks the MSCI 600 index, which means 100 extra companies than what you've got in the S&P 500. We know that it's really the tail end that we're talking about, so the impact of that difference relatively small.
A little bit
much bigger impact is the cost differential, because the DBX Tracker USA ETF is currently still offered at 0.85% total expense ratio.
That's an internal cost that goes on ticking away in the background.
Exactly. The Satrix S&P 500 is coming out at 0.25%. So less than a third of the current cost of the DBX
Just
US.
a quick technical question. If there are these costs going on, how do they maintain the units at the appropriate price? Because the index will be doing what it's doing and the currency will be doing what it's doing. But if the one's got a higher fee, over time, the one that does have a lower fee is going to start outperforming.
Exactly. So that's where the fees become very relevant. You don't often see it on a day-to-day basis or in the short term, but over the long term, that cost differential starts incrementing, and that's why the cost is so important.
But I've heard via the wire, and I can see there's some kind of catfight going on. There's talk that when the Signia people take over the DBX trackers, they're going to lower the price somehow. But then they're also irritating people because they've been writing to all the end holders, and that's been irritating others that have provided those things in wrap portfolios.
Yes, very much.
What's all that about?
So we're in a bit of a transition phase here, and there's lots of promises that are being made or suggested future pricing that's put out there, but it's not current just yet. So it's not relevant in terms of today and what does that portfolio cost me today. Also, the pricing that has been sort of put out there seems to only relate to investors that buy their new, also the existing DBX trackers directly from Signia. But the rest of us that invest maybe in stockbroking portfolios or, as you say, wrapped funds of some sort will not be going that route. And the question is still then, what is the cost, the TR for that? I think one of the concerns also around this is that one of the things that makes an ETF such a democratic investment is that the same TR, the same total expense ratio, applies to all investors. So whatever they do in terms of preferential costs have got to be done outside of the ETF in some form of rebate or reduction in administration fees or whatever, because within the ETF there's only one class, which means there's only one fee.
Fascinating. And also, of course, the underlying structure may be changed. I don't know what Deutsche Bank do exactly to provide that exposure on a derivative basis, but maybe they could also do a deal with one of the global exchange-traded fund providers to get that cost down. I mean, that's the benefit of competition.
So at the moment, definitely no derivatives in it because it's not allowed in ETFs. So it's got to be physically held. But for the time being, also, the asset management of that underlying portfolio will still be done through DBX and through Deutsche. And yes, they will have access to the Deutsche book in Europe in terms of it. But over time, the intention is for Signia to take that over, but that will take time, and there's certainly a skill set, I think, that will have to be acquired over time. So time will tell. I think it's early to make rash decisions on jumping the gun in terms of the DBX tracker products.
Okay, good. Well, we're sort of bringing ourselves now to the end of the time we've got available. So let's go with our usual kind of thing about hot or not. So if people have the particular circumstances, they don't want to do the global investing by getting exchange control approval and sending funds offshore. They want this kind of thing. Would you say that this is a good time to be getting in? And which would be the hottest of your recommendations with regard to the product and the provider, if you don't mind? So I guess that's what I'm trying to get you to, is we sort of touched on lots of different products, but which is the hottest?
So for me, the hottest where we stand right now will be the new Satrix Emerging Market ETF that they will be issuing. And it's hot for me for several reasons.
Emerging Market ETF, which is one of the ones listing on the market on the 25th.
That's right. That's
and what will the code be? Do you know that in advance?
STXEMG.
STXEMG.
That's it. So why do I like it? So the first thing is, I've spoken about investing for the future, investing in emerging markets, and that's my preference. I'm an investor. I'm not a trader. I'm not a speculator. I invest for the long term, so I would want to have that exposure and growth to the emerging markets. The second reason why I like this is because this comes in an ETF form, not an ETN form. So the current one available, which is offered by DBX Deutsche, is an emerging market exchange traded note, which means it's not physically publicly backed, and there is the additional credit risk of Deutsche also in that investment. So this is a physically held ETF, comes at a much lower cost. It will be offered at 0.4%.
0.4 because it's got, again, got some sort of global thing that's happening in the back end with BlackRock.
Yes, and the third reason why I like this is this one is going to be tracking specifically the MSCI Emerging Market IMI, which stands for Investable Market Index, which means unlike the overall emerging market index, they select the most investable, the most liquid,
if there's some big
and
company,
accessible.
but it's held by, you know, one person and his closest family, then they take it down because they don't want that kind of thing.
So you're really getting a very pure access to what is readily available to investors.
So it's going to be the MSCI IMI ETF. Have you got that, people? And the code is going to be STXEMG. EMG.
Yes, indeed.
Whew, I hope people were taking notes because
Lots
there's a lot
TLAs,
of
three-letter acronyms.
TLAs? What's that? Three-letter acronyms. Damn. Anyway, good stuff. Thanks very much to Nerina. She is an ETF strategist and advisor, as you can well tell. We don't have the usual hots or nots because there's only one hot coming out of this conversation. But obviously, if you want to, go back and watch this show on our website on cnbcafrica.com, where the clip will appear in a day or two. If you want to get hold of us directly, or if you want to make comments, which we'll use on our Friday show, you can send those via Twitter to @Paul_Vestact or @Nerina_Visser.
That's it.
In fact, you're in this business to deal with people's queries and observations and questions. So people can get hold of you initially on Twitter or by, what's your email address? You don't mind giving that out?
No, not at all. Nerina V @etfsa.co.za.
Nerina V @etfsa.co.za. Excellent.
Indeed.
Good.